Hey, this is Kehinde Fawumi. You're listening to the Unleash Your Genius podcast. What are stocks? What are bonds? What are index funds? So a stock is an equity instrument carrying ownership interest, but that may not make any sense to some people. What this means is that you want to have a part ownership in a business. So having a stocks in a business gives you part ownership. And I like that fact because for example, like what Tesla is doing. So I own some shares in Tesla, and indirectly I'm supporting the purpose, the mission that Tesla has, to put the world in the direction of renewable energy and electric cars and the likes. So I like that purpose. I like that vision. I want to support it. And one way to do that is that, okay, I own part of that business by owning the shares. So how you make profit from that is that when this company, increases in its worth, it means that shares also increase. For example, from 100 to 120. And then if you had bought ownership or part ownership of that business at 100 and now it's worth 120, you've made a profit of 20. You see that? So that's the concept, that's the idea, and that's what stocks basically means. They are traded through a central exchange. So basically, when you trade in the stock market, that's more like this central exchange market and all that. And please note that there are two types of stocks. So there's the common stocks, which is what we are basically talking about here, common, and then there is the preferred shares. Generally, since 1929, stocks have been seen to earn, investors about 10% per year. It's high risk, but it's also high reward, generally speaking. High risk because there is no guarantee that you would always gain. There are times that the financial market is just down and then the stocks are down, and then whoever is not smart enough may lose their money. So for bonds are a bit different. Bond is like, to describe it, the definition is debt instrument with a promise to pay back the money with interest. The best example, or the best way to explain it to you, is to give you an example. Recently, there was COVID pandemic. The US economy went down, and now the Fed or the government needs to raise some money. So we need more money, right? And one way to do that is to say that, okay, we borrow that money from the public. So we need people to give us money, but we promise you that after 10 years, we will pay back that money with an interest of 10% or 20% or whatever, or in this case, it says generally it's around 6%. So let's use 6%. But the thing is that for bonds, you only get your money back with the interest at the end of these 10 years. So there's a term that is set. I borrowed the government the money, or the issue bonds, and then I buy the bonds by basically borrowing them the money and then get the money back with interest at the end of the day. So it's traded over the counter because you really don't trade. Over the counter means that usually the government will give you instructions on how to do it. So it's not a central exchange market that is done online somewhere. Again, lower risk, lower reward, because you will always get your interest. The government cannot lie to you. They will fulfill their promise. So it's lower risk, but lower reward because the percentage is fixed and it's not always super high. Index funds think about the fact that the US can collect, for example, the 500 best companies in the US and say that, okay, these are the best performing markets or companies in the US, and we call them S&P 500, for example. There are different names for it, but this is a perfect example. S&P 500. We have the chance for investors to buy into all these 500 companies all together. So you buy into them all together. And the thing is that even though some of the companies here may not perform at best, but as long as some of them are performing good, you get the cumulative effect of all their activities and their profits and their losses and all that. So it's moderate reward, moderate risk. It's usually also performing at the rate of 8% per year, thereabout. So for starters, it makes absolute sense to start by investing in those funds, for starters, because it's a bit safer for you to do that. what I try to do is to ask myself, when I think about a stock, I ask myself, is this a slow grower? Is it a moderate grower? Is it a fast grower? Is it cyclical? Is it turnaround? Is it an asset play? Now I'll tell you what that means. A slow grower is a stock that is from a large company typically, but the growth rate is not much on a yearly basis. So per year, it only grows super slow, 1 to 4%. But usually they also pay really good dividends. So the reason you probably want to consider them, I don't like them, by the way. The reason you probably want to consider them is if they have, some really good dividend for you and you want to just get in there for a long term, then you can consider them. Also because they're a bit safer, because nothing much can go wrong. They're not super innovative, so not so much fluctuation is happening there. But the moderate growers are in between, basically, which means that the growth rate is actually between 10 to 12% per year, this per year now. And then, but one thing is that if this kind of companies get a sudden surge, 30% to 50%, increase, maybe something happened in the market, someone tweeted something, this kind of, activities, or COVID-19 happened, and then they just, got a lot of gains out of that, then I would advise just sell it off. The reason is that it will normalize again after a while to 10 to 12%. But if you've made this gain, you will lose it again, by the time it gets back here. So if you get lucky and then you have a huge surge in this kind of companies, sell it off. You've made your gain, get out and think of other aspects. Fast growers. I didn't have a perfect example for this one. This is McDonald's. I didn't have a perfect example for this, but now that I'm thinking about it, a moderate grower, actually, the way I see it will be Netflix. Netflix has made a super nice gain because of the COVID situation that happened, But my point would be like going forward, when things normalize, they have a subscription business, super nice and all that, but I don't see Netflix as a fast grower 1 year later. I think people would normalize, people would get used to it. New, inventions will come up in different markets, and then this would normalize and it become a moderate, but it would not go to a slow grower. So if you are in Netflix, just get in, get your gain. If you make 50, if you make even 70, because it's been super high recently, then just get out and then normalize again. Fast growers are super high growth rate, 20%, Tesla, Amazon, Zoom. Zoom was so lucky with regards to the COVID-19, because everyone is working at home and you need some kind of, video conferencing service, or all meetings are happening remote. Now we are using Zoom right now, right? So, so they've been so gaining so much. On some of my stocks in Tesla, I've done 200%, I'll show you super soon. People that invest, I don't have Amazon, but people that invested, I've done, 300 or something like that. Actually, it was said that if you got into Amazon at 2010 and you invested only $100, today this $100 would have become $1.3 million. To give you an idea how huge the gain of Amazon has been in over the years. 2010, you got in 10 years, $100 turned 1.3 million. I don't know what else could get you that. And that's the idea now that people are having with Tesla. I've done 200%. I intend to stay longer there, but I'll show you a bit more there. I just don't want to take so much time. Cyclicals. Cyclicals are airlines. When COVID happened, it's all down. When COVID is gone, it's all up again. Or other cases like that. Actually, some car companies could also fit into this. When a pandemic happens, people don't have a need to buy too much cars, right? So their stocks go down. When everything is booming and economy is restored, then it goes up again, So that's what you want to see there. So you want to know, okay, is this a cyclical? And the point is that if it's a cyclical, you can get in when they're riding with the wind in the positive, but you know when to get out, because then it turns around again and then it goes back down and up and down and up. Turnarounds are potential fatalities. So basically, during market crashes, companies that are already doing good just goes all the way down, and then everything is out and everything is clear. So it's a super risky kind of stocks that you want to watch. But there are possible ways to gain here. There could be huge gains in rare cases, which is shorting. It's a process of making gains from turnarounds. shorting. You know, I've told you that when a stock price is low, then you buy it. When it's high, that means that it has appreciated, you sell it. What I didn't tell you is that you can not only make gain in the upward movement, you can also make gain in the downward movement, and that's shorting. Asset plays undervalued stocks. For example, recently NEO got a super huge gain, and why? Is because it's been undervalued for a while, and then when the market realized the mistake, it was readjusted. You know, so if you notice that this stock actually worth more than it's listed for in the market, and you know this because you have access to some insider information, then you can be smart enough and then get in at that low because it's about to go high.